attendees are still arriving in the seminar room, so we're giving it a few more seconds, and then we'll get started.
Okay.
Hello, everyone. I am Refet Gurkaynak, one of the organizers of the virtual seminar on monetary economics, together with Claudianis Trefi, Michael Bauer, and Michael McMahon. This is the third session that we are organizing, and we are extremely lucky to have Jordi Gali, who wrote the book on the topic. So I'm not going to go into the introduction of who Jordi is, what he has done. There is a reason why we already have more than 200 people in this room looking to hear from Jordi. So I'm going to turn it over to him. But I'd like to remind you how we run this. This is going to be not the interactive format, in that Jordi is going to deliver the talk, and then we will have a Q&A. But in between, please use the Q&A button to enter your questions and comments. I will be keeping an eye on them. And if there are clarification questions or immediate things that I might be injecting, I will ask Jordi to take a moment to respond to those. Otherwise, at the end of the talk, we'll get to Q&A. And with that, Jordi, the floor is yours.
Okay, well, hi, everyone. Thanks for joining this webinar. And thanks to the organizers for inviting me. I told Refet that when he approached me to invite me, that I at some point I had promised myself I would not do an online seminar again in my life. But as you can see, I break my promises easily.
I am very persuasive.
That also helped, yeah. Very good. So, so the title of this is Rethinking Monetary Policy Rules, and there is no paper behind this. I'm happy to share the slides, or if you have a place where you can post the slides, I don't have a problem with that. And this is part of a broader project that I have tentatively titled Rethinking the New Keynesian Model, in which I go different aspects of the New Keynesian framework that I'm not completely happy about, or that I think there are ways to. There's room for reformulation in a way that that may be more insightful or more useful. So this is this deals with one block of the model, the monetary policy block, one of the three equations, if you will. Okay, and again, it's meant to just provoke some thought about that block. So so the outline of my talk, this will be a talk on, it will be somewhat narrow. It will focus on policy rules. I will start with a reference to the Taylor rule that you're all familiar with, and its positive and normative aspects. Then I will go on to point to some caveats or pitfalls in the Taylor rule in a number of dimensions, but in particular, when it is used as a tool for assessing whether monetary policy is appropriate or not. And then I'll make, and this is the the most novel part of my talk, I will make a case for using long-term real interest rate rules as opposed to rules for the short-term nominal rate as the Taylor rule. So as I said, there's no paper, and at least not at this point. But this is based on some ideas that I conveyed at lecture, the Keynes lecture at the University of Cambridge, and that's it was recorded and it's available. There's a link on my website, and it also, this particular part of the project draws heavily on a discussion that I had the opportunity to do at Jackson Hole last summer of a paper by Nakamura, Ridley, and Stensons called Beyond the Taylor Rule, which is a very interesting paper. So this draws on some ideas in that paper and on my discussion. Very good. So let me get started. So I mean, everyone here is familiar with the Taylor rule, the original Taylor rule. So here's the famous equation that Taylor put forward in 1993. The way Taylor formulated his rule, IT here would be the annualized interest rate, the federal funds rate, annualized. PIT would be the year-on-year inflation rate, and YT hat would be some measure of the output gap, some deviation of log GDP from trend, a linear trend in the case in Taylor's original paper. And well, associated with this equation, there is a picture that you are also familiar with, and it's probably one of the most famous pictures in the history of macroeconomics. And it's a picture that shows the federal funds rate, the actual federal funds rate set by the Federal Reserve, together with the interest rate generated by what Taylor modestly called a policy rule. Okay. And this is over a particular period. These are the early years in Greenspan's tenure, okay, so from 1987 to 92, okay? The paper was written in 93. So obviously the basic message that Taylor meant to convey is that simple equation captured very well the evolution of the federal funds rate, so it could help us understand what were the factors that the Federal Reserve had took into account in order to make its policy decisions. Okay. Now, not surprisingly, given this powerful or this good descriptive power of the Taylor rule, when researchers have incorporated a monetary policy rule in their models, particularly in the class of new Keynesian models, they have used some version of the Taylor rule. So here you have on the screen you have the simplest version of the Taylor rule, and with phi pi and phi y, these are coefficients that can either be calibrated or can be estimated and so on. But again, the basic point is that this is meant to be a rule that describes how the Federal Reserve and other central banks, okay, during certain periods of time have conducted monetary policy. So it's meant to be a realistic description of monetary policy as opposed to counterfactual policy. Now, it just so happens that the period covered by the sample period in Taylor's original paper was also a period that now we call the Great Moderation, that was characterized by a very good macroeconomic performance in the US, in the sense that inflation was low and steady, and also recessions were few and very mild and so on. So that's what we call the Great Moderation. So then a consequence of this is that many people, including Taylor, concluded that the Taylor rule was not only a good description of monetary policy in a particular country, in a particular period, but also a description of good monetary policy. Okay, so how monetary policy should be conducted. Okay, so this is the normative dimension of the Taylor rule. Okay, so from this point of view, deviations from the Taylor rule could be if large, could be viewed, should somehow be explained, or otherwise could be interpreted as instances of bad monetary policy. So this perspective has been adopted in many papers by many authors and also central banks and so on. And it usually, a common exercise that I don't know, all of us have carried out at some point is to compare the interest rate implied by the Taylor rule with the interest rate adopted by some central bank in some period. Okay, so now I'll show you a picture from the Nakamura et al. Paper that I mentioned earlier, in which they do precisely this. Okay, so here they use the original Taylor rule with retrospective data. Okay, and the gray area corresponds to the original Taylor sample period. Okay, so, and Taylor himself, in '99 and others did similar exercises. So one of the basic points is to point to large deviations from the Taylor rule. So, for instance, in the late 60s and 70s, we see that the federal funds rate was substantially below the Taylor rule, and this has often been pointed to as an explanation for the great inflation. Taylor himself pointed to the fact that in the run-up to the financial crisis, the federal funds rate was also substantially below the interest rate implied by the Taylor rule, and that may have been, under his view, one of the reasons behind the housing boom and the subsequent collapse and the ensuing financial crisis. Okay, now more to the point of this talk and of Nakamura et al.'s paper. If you look at the more recent period, okay, the recent inflation surge. In the post-COVID episode, we see also a large deviation from the Taylor rule. Okay, so in particular, we see that the Federal Reserve takes a long time to raise the federal funds rate, and it raises it by much less than what the Taylor rule implies. And again, many people have pointed to this as a possible factor behind the large increase in inflation itself. Okay, if the Fed had raised interest rates earlier and more forcefully, perhaps we wouldn't have seen this increase in inflation. Okay, so this is what I call an example of using the Taylor rule for assessing either in real time or retrospectively the goodness of monetary policy. Okay, now in the context of this assessment, okay, or this perspective, okay, there's an important feature of the Taylor rule that is generally viewed as like a minimum desideratum that a good monetary policy has to satisfy. That's the so-called Taylor principle. Okay, so in particular, in the context of a simple three-equation New Keynesian model, the Taylor principle takes the form that you see here on the screen. Okay, where beta is the usual discount factor, kappa is the coefficient in the New Keynesian Phillips curve. Okay, and this is a condition, a necessary and sufficient condition for local uniqueness of the equilibrium. If this condition is violated, the possibility of the multiple equilibria emerge, and the possibility of sunspot fluctuations, these fluctuations that are unrelated to fundamental shocks, emerges, and obviously this is viewed as undesirable. Now notice for future reference that, you know, beta is typically very close to 1. Okay, so the role of phi is small in this. So for all practical purposes, we can just ignore phi and think of the Taylor principle as implying that phi pi has to be larger than 1. Okay, which has a simple interpretation, namely that in the phase of an increase in inflation, the central bank should increase the nominal rate more than 1 relative to inflation. Okay, so that the real rate increases, and that would tend to stabilize inflation. Okay, very good. Now, if we look at recent developments, and again, here I will ask you to look at the most recent period here. So this is for the US, and what you see plotted is the policy rate and inflation. We see that inflation obviously went up substantially during, you know, in the aftermath of COVID, but the policy rate went up by less than inflation. Okay, at least for a substantial amount of time. So at least apparently the Taylor principle seems to have been violated. Okay, and the same is true for the euro area and other countries. Okay, this is something that is quite general during this episode. Okay, so this is a possible source of concern and a possible explanation for the large increase in inflation. Okay, very good. So that was the introduction. So that were the motivation for what I will do next. So let me start with 2 observations. And what will follow, at least for a few minutes, will be just not a proof, but a proof by illustration, I guess, of these observations. Okay. So 2 observations on the use of Taylor rules for policy assessment. First, an optimal monetary policy is not generally implementable by means of a simple Taylor rule. Okay, so you know, a central bank may be following an optimal policy, and you know, an econometrician estimates a simple Taylor rule. Obviously, it's a misspecified interest rate rule, and the estimates of coefficients in that Taylor rule may be misleading. Okay, and I'll show you some examples of that. And secondly, even if it is the case that an optimal, or at least a good monetary policy can be implemented by means of a simple Taylor rule, okay, the observable outcomes, okay, may not always satisfy the Taylor principle. Okay. As a result, deviations from the Taylor principle, like the ones that we have just observed in the recent period in the US and the euro area, should not be interpreted automatically, okay, as prima facie evidence of bad monetary policy. Okay. So so let me illustrate these 2 observations. Okay, so the way I will illustrate this is by taking a simple New Keynesian model. So you see here the equations 1 and 2 represent the private sector block of the New Keynesian model with 2 shocks. UT is a cost push shock that generates a trade-off between inflation and output stabilization, and ZT is a demand shock that in principle could be fully offset by a commensurate adjustment in the interest rate, the policy rate, which is IT, the short run nominal rate. Okay, the notation I think is straightforward, and then we have the central bank is assumed to minimize a standard loss function where theta is the weight given to output gap fluctuations. Okay, and UT is just assumed to follow an exogenous AR1 process. Okay, so let's consider. We'll consider 2 cases. So the case of discretion and the case of commitment. So this is exactly, I'm following I think it's chapter 5 in my textbook. Okay, even in terms of notation. Okay, so we can obviously I won't go over the derivations here, but let me just remind you of some results. In the case of discretion, that is when the central bank takes as given expectations about future variables, under the optimal policy, inflation is tied to the cost push shock according to the equation that you see here. So the star here denotes under the optimal policy. Okay, so it's the optimal level of inflation. The solution to the optimal monetary policy problem. Okay, and also in equilibrium under the optimal policy. Okay, we can we can solve for optimal inflation, optimal output, and then we can use the dynamic AS equation to uncover the nominal rate that is consistent with that, and it's easy to show that it takes this particular form. Okay, so in response to a positive cost push shock, the nominal rate goes up in equilibrium, and it also increases 1-for-1 with this demand shock, ZT, because that fully stabilizes output and inflation. Okay. Now, if you combine the first equation with the second equation, okay, that allows us to write IT star as a function of inflation. Okay, just substitute for UT using the first equation, and you get this simple expression. Now, look at this equation. One could think, look, this looks like a Taylor rule, okay, a simple Taylor rule with inflation only as an argument. So maybe we can think of this as the rule that the central bank should follow. But we run into a potential problem, namely, if this ratio, this sigma kappa divided by theta is less than 1, this term in square bracket is going to be less than 1. And the Taylor principle will not be satisfied. Okay, so that's not good. There is a simple solution to that, and that's something that I discuss in chapter 5 of my textbook, which is the following. In order to derive a rule that will implement the desired outcome as a unique equilibrium, what you do is you write down the equilibrium interest rate under the optimal policy, and then you append a term, okay, that involves a response of the central bank to deviations of inflation from optimal inflation, okay? And to the extent that the sum of the coefficients on inflation, that is this plus this, is larger than 1, or equivalently, if this condition is satisfied, the Taylor principle is satisfied, the equilibrium is unique. The equilibrium implies that inflation equals desired inflation, so this term is 0 ex post, and as predicted, equilibrium under the optimal policy involves the equilibrium nominal rate under the optimal policy looks like this. Okay, very good. Okay, so that takes care of the problem for the central bank. Now let's put ourselves in the position of an econometrician. Okay, the econometrician will not observe this term. Okay, because this ex post will be 0. So what the econometrician will observe is this term, is this relationship, I should say. Okay, so now let's assume that the econometrician estimates a simple Taylor rule, okay, of this form. Okay, so let's look at some things that the econometrician may run into, some problems. So, first, suppose that this ratio is less than 1. Then the coefficient in square brackets will be less than 1, and OLS estimates this coefficient consistently. Okay, because why? That's important, because this error term is orthogonal to inflation. Okay, so OLS is actually a consistent estimator of this. So our econometrician will estimate this consistently and will conclude that the Taylor principle is violated, and hence that this central bank is, the monetary policy it's following, it cannot be a good monetary policy. Okay, Very good. So that's the first observation. The second observation, which is kind of a side remark, but I think it's interesting. When the econometrician estimates this rule, okay, typically he or she will interpret the residual as an exogenous monetary policy shock. Okay, but it is not an exogenous monetary policy shock. Okay, it captures an optimal response of the central bank to demand shocks. Okay, so this is one additional way in which the econometrician will be misled. This is, in fact, these are movements in the interest rate that are not just random and generate unnecessary instability like monetary policy shocks in our models. This is a movement in the interest rate that is absolutely desirable and it's stabilizing. Okay. Third observation, well, a problem with a rule like this, okay, again, this is the rule that implements the desired outcome as a unique equilibrium, is that, you know, it's important that this term is here, okay? Otherwise, we cannot guarantee uniqueness of the equilibrium, but this term is never observed. So, you know, there's a question of credibility for the central bank, okay? The central bank needs to convince people that if inflation were to deviate from desired inflation, it would respond sufficiently strongly, but this is never observed, okay? So it's you know, at least it's a challenge for monetary policy, okay? Now, again, as a side comment, in this particular case, okay, the problem would be taken care of if and this is what we, you know, we argued in my paper with Rich Clarida and Mark Gertler in the Science of Monetary Policy in '99, if the central bank, instead of following the conventional Taylor rule, followed a forward-looking Taylor rule. Okay, in that case, this equation, no, this rule would implement the desired outcome as a unique equilibrium. Notice that this coefficient would always be larger than 1. It would satisfy the Taylor principle, okay, which is the same even if it's a forward-looking rule, okay. Hence, an econometrician that estimates a forward-looking interest rate rule would not be misled. Okay, it would actually estimate, it would obtain a coefficient here is larger than 1, and it would conclude that the Taylor principle is satisfied, and so on. Okay, very good. In the case of commitment, I'll go a bit faster on this. Things are a bit more complicated because the optimal policy implies that the price level is stationary, not inflation, and that the price level responds to UT. Okay. Now, one can show that in equilibrium, under the optimal policy, the nominal rate will satisfy this, must satisfy this relationship, okay, under the optimal policy. And again, we need to guarantee, when we have a rule like this, in which the nominal rate responds to the price level, the condition for uniqueness is that the coefficient is positive, okay? But notice that we cannot guarantee that it's positive, okay? Because if this is less than 1, we're in trouble. Again, there is a way to guarantee uniqueness, which requires adding this term that involves a response of the central bank to any deviations of inflation from the price level from the optimal price level, okay? If the sum of the coefficients on P is positive, that is, if this holds, okay, then the equilibrium will be unique, this term will be 0, and this condition will be satisfied, okay? Now let's assume, but again, this will not be observed in equilibrium, so what we will observe, what the econometrician will observe is this. Now let's suppose that the econometrician estimates a Taylor rule like this, okay? The econometrician doesn't know that the central bank is following this sort of complicated optimal policy with commitment that involves the station responding to the price level and so on. No? The econometrician estimates a standard Taylor rule, and then one can show that asymptotically the OLS estimate of phi will converge to this term. Okay, obviously it's misspecified, the rule is misspecified. Okay, so this is an example of what I was saying earlier. okay, that the optimal policy does not always imply, or doesn't always take the form of a Taylor rule, okay? The OLS coefficient will converge to this, and again, look, there's no reason why this should be larger than 1, okay? So if this is less than 1, again, the econometrician will conclude that this is a terrible monetary policy, does not even satisfy the Taylor principle, even though it is the fully optimal policy, okay? It's the optimal policy with commitment. It's impossible to do better than this, okay? So this is related to a point that Nakamura, Ribley, and Tyson make in the paper. They do simulations of a new Keynesian model, and they conduct the Monte Carlo simulations, and they estimate this, and this is just an analytical version of a point that they make. Now, let's just, for the sake of looking at the data, even though obviously this is very informal, let's run this. Let's estimate this simple Taylor rule using US data, okay? And here I'm using the period 91-24 because the data I will use later is restricted to this period, okay? So again, this may come or not as a surprise to some of you, but after, given the pictures that I showed you earlier, maybe it shouldn't come as a surprise. If you estimate this simple Taylor rule over this period, these are the coefficients that you obtain, the coefficient on inflation, okay? 0.15 is using CPI inflation, this is 0.43 using core PCE inflation, okay? So coefficients that are less than 1, okay? So the econometrician concludes the Fed over this period has deviated a lot from a Taylor rule. It has deviated so much that it has not even met the Taylor principle. So this has been a disaster, okay? Now, someone may come and say, oh, come on. I mean, this is not surprising because there have been at least 2 episodes in which the zero lower bound was binding. So it is obvious that, the Fed could not follow something like a Taylor rule. Okay, let's dummy out those periods, the periods in which the ZLB was binding. Okay, so that's what I do here. And still, for the remainder of the sample, the coefficients are significantly less than 1. Okay, they don't satisfy the Taylor principle. So this is not explained by the ZLB problem. Okay, very good. Okay, so the basic message from this: simple Taylor rules can be misleading when they are used for assessing monetary policy. Okay, now let me be a bit more positive now, more constructive, and suggest an alternative. Okay, that will have also other advantages, I would claim, but I will focus on the particular dimension of policy assessment. Okay, so this is long-term. So what I'm going to propose is to use rules in terms of the long-term real interest rate, as opposed to the short-term nominal interest rate, okay? If you want Taylor-type rules, okay? So why? I mean, what's the motivation for this? So a simple motivation, it's theory-based, comes from the observation that the main components of aggregate demand, namely consumption and investment, are a function of the long-term real interest rate. So here, this is the consumption function derived from combining the linearized Euler equation with a linearized intertemporal budget constraint in the case of a representative consumer. Okay, so we see that consumption, deviations from steady state, depend on current and expected future output and current and expected future interest rates, and in addition, it depends on ZT. In this case, ZT is a discount rate shock. Okay, where R now is the real interest rate. Okay, it's the nominal rate minus expected inflation. Okay, now at the same time, we can derive the real yield on a console paying a constant real coupon. Okay. this is what I will take as a benchmark for a long-term asset. Okay, and one can show, again, up to a first order approximation, that is ignoring risk premia, that that yield, that real yield on the long-term asset, is a weighted average of current and expected short-term real interest rates. Again, this is not surprising. Okay, you're all familiar. We're all familiar with this result. But that means if we combine the two results, it means that we can write down consumption, the level of consumption, as a function of the long-term real rate. Okay, and we can do the same for investment if you assume, if you derive the
Jordi, may I stop you for 1 second and remind you that you seem to be in the middle of your slides, and hopefully we're going to have some time for Q&A. So will you budget accordingly?
Yes. I will skip some of the slides.
Very good. Thank you.
I was planning to do that. Okay, but thanks for reminding me. Okay, so in the case of investment, if you assume a standard model with convex adjustment cost, one can also derive an expression for investment, but depends on Q, and Q can be written as the discounted sum of expected. This would be proportional to the marginal product of capital. But we also would have a term here that is proportional to current and expected future real interest rates, or equivalently to the long-term real rate. So what's the basic point here? If monetary policy is transmitted through aggregate demand, okay, then monetary policy can affect output and inflation if and only if it manages to influence the long-term real rate. Okay, so if that's the case, so another way of saying this is that the long-term real rate is a sufficient statistic for the impact of monetary policy on aggregate demand, and hence that it is natural to think, and I would put it more strongly, not only it's natural to think of policy in terms of its impact on the long real rate, but it's the only meaningful way of thinking about policy. Again, through the lens of our model, of this standard model that I'm describing. Okay. And if that's the case, one might as well write down or specify policy in terms of a rule for the long real rate, given that that's the variable that measures the true monetary policy stance. Okay. Well, as a side comment, again, it's important to keep in mind that this will never enlarge the set of feasible outcomes. So that will not make it possible for the central bank to achieve outcomes that would otherwise not be possible. Okay, and the reason is that, if I give you a rule for the long-term real rate, I can back out a rule for the short-term nominal rate that will implement the same outcome. Okay, but, and I will try to illustrate this in what follows, and using the long real rate in empirical rules allow for a better assessment of the adequacy of monetary policy. Okay, so let me illustrate this now. Again, assuming that the same exercise as before, the central bank follows optimal monetary policy under discretion or under commitment in the basic new Keynesian model. Okay, and now our econometrician, now we will see what are the implications, how that policy can be implemented with a long-term real rule, and what an econometrician estimating a long-term real rule will conclude. Okay, so first, an observation. Okay, one can consider this ad hoc, if you want, rule for the long-term real rate. Okay, one can embed this in a standard new Keynesian model without any difficulties. Okay, you just need to combine it with this equation that relates the long-term real rate with the short-term real rate. Okay, this is the same as the discounted sum that I showed you earlier, with the dynamic IS equation in terms of the short-term real rate and the new Keynesian Phillips curve. Okay, you can combine them and derive an expression, a difference equation for equilibrium output. Okay, and we know that this has a unique solution if and only if this coefficient is less than 1, which is the same as saying that this has to be satisfied. Okay, again, forget about phi y, let's focus on phi pi. Phi pi has to be positive, which, okay, you can interpret this through the lens of the Taylor principle. It says that in order for the equilibrium to be unique, okay, when inflation increases, the long-term nominal rate has to increase more than 1-for-1 relative to long-term inflation expectations. Okay, that's what a positive FPI does. Okay, very good. So now let's go back to the optimal monetary policy problem. One can show, it's straightforward to show, that the optimal monetary policy with discretion can be implemented with this long-term real rate rule. Okay. Now, notice that this involves a coefficient here that is always positive. Okay. So, the equilibrium will be unique. And this rule does not require any term that involves responses to off-equilibrium deviations of inflation. Okay, so the inflation coefficient under the optimal policy is always positive and can be estimated consistently with OLS. Our econometrician will not be misled in terms of the adequacy of monetary policy. There is no problem of credibility because there is no unobserved off-equilibrium response required. Okay. And also, it's important to see, this is a bit outside the model, certainly outside, not the forward guidance part, but the QE, that in practice, the long real rate also will capture the impact of forward guidance and QE, okay? Okay, which obviously are part or help determine the stance of monetary policy. In the case of the optimal policy with commitment, one can show that this rule for the long rate, the long real rate will implement. Okay, again, it's a complicated rule that responds to the price level. And again, so let's suppose that our econometrician estimates this simple rule for using the long-term real rate. Okay, one can show that the OLS estimates of FPI will converge to this term. Again, it's misspecified. It's misspecified in this case, but at least the coefficient, the estimated coefficient of FPI will as long as beta is not too close to 0, okay, will always be positive. Okay, so at least the econometrician will conclude that, you know, that the Taylor principle, that the condition for uniqueness, which is that this coefficient is positive now, is satisfied. Okay. Again, let me look at the data. Okay, now I'm going to estimate this simple interest rate rule, but now for the long-term real rate. Okay, so first I need to construct a measure of the long-term real rate, and I use the 10-year Treasury yield minus the 10-year SPF inflation forecast, the survey of professional from the survey of professional forecasters. So this is the object, and notice that it has, obviously it varies over time, but two observations, quick observation on this. The shaded areas correspond to the periods in which the ZLB was binding. Notice that during those periods, the Federal Reserve managed, you know, to move around, maybe through forward guidance, maybe through QE, who knows, okay, managed to move around the long-term real rate. And the second observation, most importantly regarding the recent episode, the long-term real rate started going up as early as 2000, okay, in response to increasing inflation, okay? And that's the condition for, determinacy, that the long-term real rate goes up, okay, when inflation goes up. And this was very clear here, okay? Even though the policy rate was flat and responded very little when it started responding. So if we estimate this using US data for the same sample period as before, we always uncover a coefficient on inflation that is positive and highly significant, okay, which is the requirement for a unique equilibrium. Okay. I will not go over this because we don't have time, but basically what I argue is that using the long-term nominal rules for the long-term nominal rate or rules for the short-term real rate will not solve all the problems. And I illustrated through some examples in which our econometrician is misled when estimating a rule for the long-term nominal rate or the short-term real rate, as opposed to a rule for the long-term real rate, which is, as I tried to argue earlier, the one variable that measures correctly the monetary policy stance. Okay, so this is what I'm skipping. And just one picture before I conclude. In the Nakamura, Ripley, and Steinson paper that I discussed in the Jackson Hole conference, they made an interesting observation regarding much of the paper is on the gains from having well-anchored inflation expectations. And one of the points messages they want to convey is that if you're a country with well-anchored inflation expectations like the US, when you have an inflation surge, you don't need to be so aggressive in responding to inflation, okay? And they illustrate this by comparing the policy rate, the short-term nominal rate in the US and in Brazil. And they show, and you can see it here, that in Brazil, the central bank increased the policy rate by much more than the US. And despite the inflation went up more than the US. And then they claim, well, look, these are one of the gains from having well-anchored inflation expectations. I'm not questioning that conclusion. I'm questioning the fact that the picture on the left, implies or should be interpreted as the central bank in Brazil having conducted a monetary policy that is tighter, okay, or having had to tighten monetary policy more than, or having tightened monetary policy more than the US. Because if instead of looking at the short-term nominal rate, you look at the long-term real rate in the two countries, the levels are very different because they have different averages. But if you look at the movements during this episode, they move in parallel, okay? So if you think of that variable as the relevant variable measuring the monetary policy stance, you cannot conclude that the Central Bank of Brazil, pursued had to tighten monetary policy, tightened monetary policy more than the US. Okay, so again, this is just to illustrate the fact that what variable you use to measure the monetary policy stance matters for your conclusions. Okay, so I'm done. I'm happy to take questions if people have some questions. So just let me just summarize the messages that I wanted to convey. First, fitted Taylor type rules may be misleading unless, obviously, the central bank literally follows the Taylor rule. Then that's the right thing to estimate, obviously. Now, through the lens of the new Keynesian model, the long real rate is the best indicator of the monetary policy stance at any point in time. So one might as well think of rules in terms of the long-term real rate, either as researchers, I would argue, or as policymakers, okay? Simple long real rate rules may be embedded easily in a standard new Keynesian model. In fact, they facilitate the solution of the model quite a bit. And this is the main message that I wanted to convey, is that looking at the long real rate, or more narrowly if you want, estimating empirical long real rate rules may provide a better assessment of the adequacy of monetary policy at any given point in time. So that's all I had to say, and thanks a lot for your attention.
Super excellent.
I'm happy to take questions.
A big round of applause on behalf of all of us. Let me quickly jump to the questions, of which there are many. I'd like to begin with the question I was thinking of too, which is, in my words, this kind of sounds like Woodford 99. And the way the question is worded is, how would you link your proposal to Woodford's 99 optimal monetary policy inertia argument, where the reason is that, this is in quotations, small but persistent changes in short-term interest rates in response to shocks allow a larger effect of monetary policy on long rates and hence upon aggregate demand for a given degree of overall interest rate variability.
So obviously it is related to that, okay? And so another way to put it, and actually that was in my discussion and my Jackson Hole discussion, that's something that I explicitly mentioned. If the central bank follows a Taylor rule with partial adjustment or inertia, okay, if it actually follows that, again, an econometrician that estimates a simple Taylor rule like the ones I have shown here may also be misled, okay? Because what matters is not, so because the econometrician will observe that in response to an increased inflation, the short-term nominal rate hardly changes. So from that the conclusion will be derived that, monetary policy has not responded sufficiently and so on. But obviously, to the extent that that agents know the rule, the partial adjustment Taylor rule, and so on, monetary policy may be doing a good job. But all this, again, this is another instance, another example, which I haven't used today, but I used it in the Jackson Hole discussion, in which using a long-term real rate rule would overcome that problem. Because the long-term real rate would increase in anticipation of the expected future increases in the policy rate.
Let me get to one more. How implementable is the long-run real rate rule? A central bank can't control it, and other endogenous factors are always distorting the nice equation you laid out. Let me add to this two bits. I mean, your long-term real rate was based on essentially an expectations hypothesis for real rates. And, that doesn't quite fly in the data. And one way of asking this question perhaps is to bring up the Greenspan conundrum, right? And a big part of the movement there, of course, he was talking about long nominal rates, but nonetheless, a big part of what was going on there was the term premium was shrinking. So even if we try to implement this, we might find ourselves in cases where, well, I want higher long rates for which I have to create, uncertainty, and therefore I'm going to do some, really bizarre kinds of monetary policy, which is going to drive up the long rates. Is that the kind of thing that's going to make us happy?
No, that wouldn't be that wouldn't be my first advice if you want to, to adjust the long-term real rate in one direction or another. Don't play with uncertainty, Okay, so your question, I think there were two questions in your question, both very interesting. In terms of, let's forget about term premia for a second. In terms of implementability, it's obvious, I think, that the central bank doesn't have direct control of the long-term real rate as much as it does of the short-term policy rate, okay? Which is not perfect, but nearly perfect, right? In the case of the short-term nominal policy rate. But still, I would claim that given that this is the relevant variable, okay, at any point in time, both in terms of our model or in terms of the real world, okay, the central bank should have a sense of what is the desired long-term real rate, okay? Because again, this is the variable that measures the true monetary policy stance, how the central bank affects aggregate demand and hence output and inflation and so on, okay? So then there's a question of implementation. I, as a researcher, don't have any difficulty in backing out, a rule for the short-term policy rate that will implement whatever good rule you give me for the long-term real rate, okay? Now, in practice, we know that central banks don't follow, mechanical rules, and particularly so, not that may be a bit complicated, like the one that would implement a long-term real rate, okay? But still, it is true that at any, if you accept my first premise, namely that the central bank should care more than anything else about the long-term real rate at any point in time, because that's the measure, the true measure of the monetary policy stance, then it should conduct its policy in whatever way it thinks best, so that given the current policy rate and given agents' expectations about the future path of the policy rate, the long-term real rate is at the level that the central bank deems desirable, if not exactly, approximately. Okay. Now, in terms of the term premium, it's true my analysis has ignored risk premium. Okay, just for simplicity. It obviously what matters in the real world, I would argue, is the long-term real rate, including the term premium. Okay. So that's an additional reason to focus on the long-term real rate, because, you know, looking at the policy rate or even at expectations about the future policy rate may be not sufficient to capture the true monetary policy stance, which depends also on the term premium, and hence it may be shaped also, at least at the margin, by policies like QE, that on top of, you know, forward guidance. Obviously, forward guidance in the broad sense, no, which is monetary policy is forward guidance. Huh? It's because the policy rate today, you know, who cares? There are very few agents that have access to that rate. No, what matters is how the conduct of monetary policy affects agents' expectations about future policy rates.
Super. Thank you so much. Another question with a comment referring to the Nakamura and others figure that you showed at the beginning for the Taylor rule implied rate and the actual rate. You don't have to show it. It's not a question about that figure, but a comment or suggestion that have you tried to create a similar graph with the actual long real rate and the one implied by the optimal long run real rate? Based on your talk, I think these two should follow each other more closely.
Okay. One way. Okay, that's a good question.
It's not a question; it's a comment, and I thought it's a good comment, so I'm just conveying it.
It is a good comment. Again, I have derived here the optimal, for instance, the simple case. It's here. No, showed it earlier. This is the optimal. This is the long-term real rule, long-term real rate rule that would implement the optimal policy with discretion, not the fully optimal policy, but well, the one with discretion. Okay, so it'd say, okay, did the Federal Reserve follow a rule like this? Well, we don't observe the ZTs. Okay, what it's clear is that if I run a regression of the long-term real rate on inflation, I don't get a perfect fit. I can show you the R-square I get, 0.65. Okay, this is wrong. This is a typo. This cannot be. It's in the ballpark of 0.66, 0.75, and so on. Is it optimal? I don't know, because I don't know what this VT is. If it's a monetary policy shock, that's bad. If this VT that I recover is it captures, you know, the response to demand shocks that are fully offset, then that's good. And also FIPI, you know, I get these values. No, I mean, there are some differences across specifications. Are these optimal? I don't know. I don't know because I don't know. I don't know. I don't know these parameters. Particularly, I don't know theta. Okay, but at least I cannot rule out that it is optimal.
Yeah, I have two more. I don't want to tax you too much, but one is, and this was, I think, almost explicit in your talk. Does this also mean that, referring to the long run rate, real rate control, how this is done is somewhat inconsequential? That is through changing the short-term rate, QE, or forward guidance.
Yes, that would be my claim. So that's a question if it's inconsequential. Yes, certainly. It's not. It was not the purpose of my talk to argue for one way or another. That may be an interesting topic. I don't have anything to say about this. Okay, there may be alternative ways of implementing a given long-term real rate at any point in time.
Okay, and lastly, a question about the passive-active policies. Could recent deviations from the Taylor rule reflect fiscal dominance concerns? Strict adherence would raise real rates and debt servicing costs substantially. How much do fiscal sustainability considerations constrain monetary policy today? Please take this as a broad question about, your framework is still in the, broader frame of reference where fiscal policy is passive and monetary policy can just, go ahead and do, good policy. In a more fiscal dominant regime, how would this all work out?
Definitely. So, no, this is a very interesting question. It's clear. I was not explicit about it at the beginning. There is no, in my analysis, there was not even a reference in passing to fiscal policy. So implicitly, fiscal policy is passive here. And I have not explored how, if anything, would change under. Obviously, things would change if fiscal policy would be active. However, but as I said, I have not explored it explicitly. But my hunch is that the analysis would not be different at all from the standard analysis. So all the issues that arise that have to do with uniqueness or multiplicity, possibility of non-existence of equilibrium, and so on, would also arise here with the appropriate modifications regarding, the threshold value for FIPI. Okay, will be 0 instead of 1. Okay, but other than that, I think the whole the analysis would go through unchanged. So I don't think this would add any interesting novel perspective on the issue of interaction of monetary policy and fiscal policy.
Excellent. Jordi, this genuinely was a treat. Thank you so very much. At some point, we were about 350 people here, so that's not your usual, small seminar room. So hopefully it was worth your time and, overcoming your aversion to online seminars. But for us, certainly, this was a huge service and not only we learned a lot, I'm saying for myself, but I'm sure I'm speaking for everyone, but there was an immense consumption value. This was extremely pleasurable. Thank you so very, very much.
Okay, well, thank you. Thanks everyone for your attention, and thank you for inviting me. It was a pleasure.
Thank you. Next up, we're going to have one more, and all of the participants here will receive emails about the next virtual seminar in monetary economics that's going to take place in December. Thank you so much, and goodbye.